Have you ever just looked at the stock market and thought, how on earth does this make any sense? You see some companies worth billions, while others that are making huge profits are valued for way, way less. Okay, let's get into it, because today we're going to pull back the curtain on the complex and, let's be honest, kind of confusing world of company valuation.
This is the classic question, right? It's the paradox that makes you scratch your head. How can a company that's losing money hand over fist be seen as more valuable than one that's consistently in the black? Well, the thing is, there's no single ruler to measure value. It all depends on what you're trying to measure. Just look at this. It's a perfect example. On one side, you have ProfitGo. Solid, old-school business, making a cool $100 million in profit. It's worth $1 billion. Nice. But then you have FutureApp, a software company that's losing $50 million a year, and it's valued at $5 billion. No, that is not a typo. It's just a perfect snapshot of two completely different ways of thinking about value.
All right, first up, let's talk about the traditionalists. These are the investors who are laser-focused on the profit engine. For a whole chunk of the economy, the number one question is simple. How much cold hard cash is this business actually making from its day-to-day operations right now?
And for them, the star of the show is a metric called EBITDA. I know, it's a mouthful of an acronym, but the idea behind it is actually pretty straightforward. It's all about getting a clean look at the health of the actual business by stripping out all the noise from financing decisions, tax strategies, and accounting rules. It's about pure operational performance.
So how do you figure it out? It's basically a three-step recipe. You take the company's final profit number, then you add back the costs that aren't really about the core business, like interest payments on debt, taxes to the government, and this accounting thing called depreciation. What you're left with is a number that tells you how well the actual business is run.
And you see this logic everywhere in stable, established industries. Think manufacturing, logistics, telecom. Investors look at their EBITDA, and then they apply a multiple to it, maybe 8 times, maybe 12 times. The higher that multiple, the more confident they are that the company's profit engine isn't just strong today, but it's built to last.
Okay, but what about our tech company that's burning cash? Well, for them, it's a completely different game. Investors are playing a different sport. They're not buying today's profits. They're placing a massive bet on tomorrow's potential. This is the growth betting philosophy.
So you see the shift? The profit engine folks ask, is it making money now? The growth betting folks ask, yeah, but how big can this thing get? Is it going to own the entire market in 5 years? They're not even on the same field.
For a lot of these growth companies, especially in software, the holy grail metric is ARR, or annual recurring revenue. And why is that so important? One word, predictability. If a company has thousands of customers paying a subscription every single month, you can predict its future revenue with incredible accuracy. And to an investor, that predictability is worth its weight in gold.
Now, let's look at another one. For a giant online marketplace, think of an Amazon or an eBay, you'll hear this mind-boggling number thrown around, GMV, or Gross Merchandise Value. Here we have $50 billion. That's the grand total of every single thing sold on their platform for a whole year.
And this is the absolute key. That is not the company's money. They only get to keep a small slice of that, often called a take rate. So when you see a gigantic GMV number, what investors are really betting on is the sheer scale of that marketplace. They're betting on the potential to grow that ecosystem and maybe, just maybe, increase that little slice they take in the future.
So you can see here, different growth industries have their own special forward-looking metrics. Software companies live and die by their ARR. Marketplaces are judged on their GMV. And in an industry like biotech, it's all about the potential value of the drugs they have in their research pipeline. For every single one of them, the story is all about tomorrow.
So, we've got profit and we've got growth. But there's a third way to look at all this. For some companies, their value isn't about how much money they make or how big they might get. It's about the real, tangible stuff they own. It's all about the assets. A perfect example of this is the oil and gas industry. They talk about 2P reserves, which stands for proven plus probable. You can think of it as an audited estimate of how much oil and gas they literally have in the ground that they can realistically get out. Their value is tied directly to that physical resource.
And it's not just oil and gas. Mining companies, valued on their ore reserves. Real estate companies, valued on the income their buildings produce.
Even banks are valued based on their capital, the core asset that backs up everything they do. For all of these guys, the value is anchored to something solid you can count right now.
So we've walked through 3 totally different ways of thinking about what a company's worth. So how do you make sense of it all? Well, the single most important lesson here is that you have to use the right tool for the right job. I absolutely love this analogy because it just clicks. Judging every single company on its net profit is exactly like trying to judge every athlete by how fast they run a 100-meter dash. It tells you nothing useful about a champion weightlifter or a world-class swimmer. You need a different yardstick for a different discipline. It's just that simple.
So, what are the big takeaways from all this? First, and most importantly, there is no single best way to value a company. It just doesn't exist. Second, value comes from one of 3 places: today's profit, tomorrow's growth, or the assets a company owns. And finally, the real key is knowing which yardstick to pull out of the toolbox for which industry. And that leaves us with a really fascinating question to chew on. As brand new industries are being born from AI and data, what do you think their version of EBITDA or ARR is going to be? What will be the core metric that we use to value the pioneers of the next generation? Something to think about. And that's it for this explainer.